Table of Contents. 1. Introduction. Definition of accounting and financial management. Accounting is an essential component of successful business operations, as it provides invaluable details that inform smart decision-making. It involves the meticulous recording, categorizing, and summarizing of financial transactions to produce reports like income statements, balance sheets, and cash flow statements, which offer a comprehensive look into a company's fiscal position. In contrast, financial management is the art of managing an organization's monetary resources. From investing in new initiatives to financing operations and monitoring risk, it necessitates making informed decisions about how to allocate their finances. Moreover, integral components such as budgeting, forecasting, and evaluating performance are absolute musts if the firm is expected to meet its fiscal objectives. Summarized, accounting is the systematic tracking of financial activities, whereas financial management involves making strategic decisions about how to utilize monetary resources for meeting organizational objectives. Thusly, together these two disciplines give us a thorough understanding and pertinent tools to make sound choices regarding the financial well-being and future of an enterprise. Accounting and financial management not only provide the data to make educated decisions, but also guarantee accuracy and openness in all financial documentation. Adhering to generally accepted accounting principles, GAAP, and International Financial Reporting Standards, IFRS, provides a framework for financial reports, guaranteeing that they are reliable and comparable across businesses. Conversely, financial management calls for internal controls and risk management plans to ensure proper utilization of the organization's financial resources while also assessing potential risks. Money management is inseparably intertwined with other business departments like marketing, operations, and human resources. It ensures that the financial objectives of the organization are in accord with its holistic aims, while also making sure that all necessary funds for executing these strategies are available to it. Accounting and fiscal oversight are profoundly intertwined with compliance as well as the regulatory framework. Companies must abide by an array of laws and regulations about taxes, securities, and various other financial matters to remain compliant. To put it concisely, accounting and financial management are indispensable within any company. These practices provide the data and resources needed to make prudent choices while safeguarding the accuracy of financial information, as well as aiding organizations in meeting their monetary objectives alongside conformity with laws. Importance of accounting and financial management in business. Accurate accounting and financial management are essential for making well-informed decisions that will ensure the longevity of any business. By providing information and resources, these crucial functions give businesses the clarity they need to assess their current economic state and plan for future growth. For any successful business, it is important to have up-to-date and reliable financial information to make informed decisions. Accounting provides this by producing accurate financial statements such as the income statement, balance sheet, and cash flow statement, which can be used to measure a company's performance over time and identify potential issues before they become more serious. This data is leveraged to devise sound decisions around budgeting, investments, and funding operations. Moreover, wise financial administration is paramount for businesses to control and allocate their monetary resources. This involves budgeting, projecting into the future, and assessing results so that organizations can guarantee they are reaching their targeted fiscal aims. Financial management is the key to success in any organization, as it involves making crucial decisions about investing strategically in new projects, managing risk and reward effectively, and accurately financing operations. Additionally, financial management ties into other critical business functions such as marketing, operations, and human resources, which ultimately helps maintain a unified alignment between the organization's financial goals with its larger strategic objectives. Accounting and financial management are of utmost importance when it comes to adhering to regulations. Companies must meet multiple laws regarding taxes, securities, and other fiscal matters with precision. Financial statements have to be prepared according to GAAP, generally accepted accounting principles, as well as IFRS, International Financial Reporting Standards, while also conforming with all rules concerning taxation, securities exchange markets, and more. Ultimately, accounting and financial management are indispensable functions in any business which supply the details and instruments to make prudent decisions, proficiently manage fiscal resources alongside overall objectives, as well as adhere to rules. In today's competitive and rapidly changing market, businesses need timely financial data and skilled fiscal management to remain successful. Without these elements in place, companies will be unable to stay afloat. Overview of the book. This book is an ideal tool for mastering the fundamentals of accounting and financial management. From exploring the basics of double-entry accounting to learning how to calculate the accounting equation, this comprehensive guide will teach you all that you need to know to prepare reliable and accurate financial statements. This book dives deep into money matters, exploring budgeting, forecasting, cost-benefit analysis, and capital budgeting, as well as the concept of the time value of money. Moreover, an entire section on financial breakdowns provides detail on ratio analysis, common-size financial statements, trend investigation, and industry reference points. This book contains valuable knowledge about financial planning and control, such as working capital management, long-term financing decisions, and performance evaluation. Furthermore, it dives deep into the topics of tax compliance and reporting by exploring relevant laws, regulations, and requirements for filing taxes correctly. This book is your one-stop destination to explore auditing and assurance, internal controls and risk management, auditing processes, as well as techniques. Moreover, it also delves into special topics such as international financial management, governmental accounting, and nonprofit accounting, along with ethical considerations in the realm of accounting and financial management. This book culminates with a comprehensive summary of the central themes it covers, upcoming trends in accounting and financial management, as well as references for additional study. This book is an essential resource for any student, professional, or aspiring business owner who wants to gain a comprehensive understanding of accounting and financial management. It provides readers with the fundamental tools needed to make informed decisions in their businesses. 2. Basic accounting concepts. The accounting equation. The accounting equation is an integral building block of accounting that exemplifies the relationship between a firm's assets, liabilities, and equity. Transforming this concept into simple arithmetic, assets equals liabilities plus equity, demonstrates how all three components are connected in financial transactions. Assets are valuable resources and possessions of a company, including cash, investments, inventory, and property. Liabilities refer to the debts that companies owe to third parties like loans, accounts payable, or taxes. Equity is the residual amount left in a business after all liabilities have been paid off. It consists of both capital invested by owners as well as retained earnings. The accounting equation is an essential resource in comprehending a business's financial status. It demonstrates that all of the company's assets either come from taking on debt, liabilities, or utilizing equity. Whenever one portion fluctuates, it influences the other two, which maintains balance overall. For instance, if a firm obtains a new asset, it should be financed by either incurring debt or applying for equity. If they take out debt, then their liabilities will expand, and if they use up available equity, their amount will decrease accordingly. In short, the accounting equation is a basic yet influential tool that visually illustrates how assets, liabilities, and equity are linked. As it serves as the basis of double-entry bookkeeping, accountants and investors alike rely on this equation to comprehend an organization's financial standing so they can make educated choices. Double-entry accounting. With double-entry accounting, every financial transaction is recorded as both a debit and credit in two distinct accounts. This system of bookkeeping is based on the concept that each action has an equal yet opposite outcome for the balance sheets of any business. Double-entry accounting yields precise financial records that are both reliable and trustworthy. With this method, each transaction is entered into two accounts in which one account will be reduced, debited, while the other increases, credited. This ensures that all debits add up to credits, resulting in accurate entries with no discrepancies. With double entry accounting, you can guarantee precision and dependability with your financial records. It is also useful in finding mistakes like posting a transaction to the wrong account, as balancing debits and credits should remain equal. To illustrate, when a corporation acquires inventory, the exchange gets noted as both an increase in their inventory, debit, and a corresponding boost to accounts payable, credit. This transaction appears on both the income statement and balance sheet for transparency of the company's financial status. Its inclusion reflects how purchasing items adds value. Assets are obtained along with liabilities that must be satisfied. In summation, double entry accounting is a formidable system of bookkeeping, which allows for an efficient and precise way to document financial transactions. This method affords protection from fraudulence or discrepancies by providing a balanced system to accurately review all data points. As such, errors can be quickly identified and rectified through this reliable record-keeping technique. Financial statements, income statement, balance sheet, cash flow statement. A detailed understanding of a company's fiscal standing and performance is accessible through financial statements. 3 distinct documents, the income statement, balance sheet, and cash flow statement, are essential in analyzing this data to make well-researched business decisions. The income statement, otherwise known as the profit and loss report, offers valuable insight into a company's revenue flow alongside its expenditure over an allotted amount of time, e.g., monthly or annually. This allows individuals to evaluate how much money was made by that organization, in addition to what costs were associated with it, ultimately helping us decide whether the enterprise achieved profitability or not. Furthermore, this resource serves as an ideal tool for identifying operational performance within a business. At a given point in time, the balance sheet provides an overview of a business's financial standing. Assets are displayed including those with worth such as cash, investments, items for resale, and real estate. Then liabilities like loans payable to others and owed taxes come into view, followed by equity, which is comprised of funds invested by owners plus retained earnings. Together, these components make up the snapshot of your company's fiscal position on any specific day. A company's balance sheet gives an evaluation of its financial health, demonstrating whether or not it has the capacity to meet all necessary monetary commitments. The cash flow statement is a must-have for any business, revealing the amount of money coming in and out during a defined period. It's an essential tool to measure liquidity, guaranteeing that your company has enough resources to meet its short-term goals as well as make investments toward future success. This document reflects funds generated from operations, capital expenditures, and financing activities, all crucial information when determining if you have sufficient capital on hand. In conclusion, financial statements are critical in helping investors and other stakeholders to make informed decisions. The income statement offers insight into operational performance, while the balance sheet provides details on solvency, and the cash flow statement reveals information about liquidity. Ultimately, all 3 documents give a comprehensive overview of a company's fiscal well-being that is invaluable for evaluating investment prospects or determining loan eligibility. 3. Financial management. Budgeting and forecasting. Taking control of your company's financial future begins with budgeting and forecasting, integral components of successful financial management. Crafting a budget is the key to success for any company. It provides an outline of planned income and expenses to ensure that resources are distributed properly throughout the year, so your business never veers off course financially. Without a comprehensive plan in place, you may be leaving yourself open to financial uncertainty or mismanagement. Financially planning is an art. Budgeting involves forecasting revenue, calculating expenses, and deciding how to leverage resources for maximum success. This budget functions as a tool to evaluate performance, make timely adjustments as needed, and guarantee that the business is on track with its financial targets. Looking ahead and predicting a company's financial standing is what forecasting does. It takes the present data, trends, and past performance to anticipate how your business will perform in the future. With foresight into potential issues or opportunities that may arise, reliable decisions concerning investments and loans can be made based on this information. Financial forecasting ultimately aids you in optimizing your finances for success. Budgeting and forecasting are essential for organizations of all magnitudes, as they guarantee that a business has the necessary resources to adhere to its commitments and reach its ambitions. A carefully crafted budget combined with accurate predictions can aid an organization in achieving its financial objectives, changing tact when external conditions vary, and making sound decisions concerning upcoming investments or outgoings. Ultimately, budgeting and forecasting are essential for proper fiscal management. By formulating a budget, companies can assign their resources accordingly. Moreover, forecasting offers insight into what potential performance may be in the future. With these two tools combined, businesses can effectively work towards achieving financial goals while making knowledgeable investments and loan decisions. Cost-benefit analysis. Cost-benefit analysis is a powerful tool that can assist in making informed decisions by evaluating the projected costs and potential benefits of any proposed project, investment, or policy. This method helps to determine whether it would be wise to move forward and what value could potentially be gained from doing so. Cost-benefit analysis is a method that helps to decide whether the benefits of an investment or project are worth its cost. Every single expense should be considered when doing this assessment, such as direct costs like supplies and labor, as well as indirect ones including opportunity expenses and externalities. This approach will allow you to accurately determine if investing in a certain project would bring valuable returns on your money. The advantages of the project or investment must be evaluated, including any monetary returns such as increased revenue and savings, in addition to non-financial gains like improved customer satisfaction or environmental benefits. To identify the financial worth of a project or investment, all its costs and benefits are weighed against each other to calculate its net benefit. If this result is positive, then it's economically viable and should be seriously considered. However, if the net outcome is negative, you might want to think twice before going ahead with this project, as it may not prove beneficial in any way. Making informed decisions is a crucial element of success, especially in business, government, and nonprofit organizations. Cost-benefit analysis provides decision-makers with the critical information they need to weigh potential costs against benefits when considering projects or investments. This powerful tool enables users to make better choices by taking into account all relevant factors and assessing whether it would be worthwhile to pursue the opportunity at hand. Ultimately, cost-benefit analysis is an invaluable resource for making well-thought-out decisions regarding projects and investments. This method of analysis guarantees that resources are utilized in a lucrative manner, as it also verifies that the benefits yielded outmatch any expenses incurred. The cost-benefit analysis gives decision-makers a comprehensive and unbiased evaluation of costs and advantages, allowing them to make informed choices that optimize the use of resources. Capital budgeting. Capital budgeting is the process of assessing potential investments or expenses that are projected to yield long-term benefits. Businesses and organizations use this technique to establish if investing in major projects such as new facilities, tools, or research and development initiatives will be worth their while. When it comes to capital budgeting, calculating the net present value (NPV) of a proposed investment is essential. To do this, one must estimate the future cash flows that will be generated by said investment, and then discount them back to their present value. If the NPV has a positive outcome from these computations, then the economic viability of such an endeavor can be determined and taken into consideration for further exploration. If the NPV is negative, then investing in this project would not provide economic benefits and may ultimately be a waste of resources. Capital budgeting not only takes into account NPV, but also the internal rate of return (IRR), a figure that reflects when an investment's NPV is zero. This rate makes it possible to contrast various investments and choose which one will offer the most substantial return. IRR is thus useful for making informed decisions regarding how best to invest resources. Capital budgeting is an important element of financial management, as it allows organizations to make informed decisions about big investments and ensure that resources are allocated appropriately. Through capital budgeting, businesses can guarantee that the investment choice will yield positive returns in the long run. Ultimately, capital budgeting is a method of determining whether investing in something now will lead to successful long-term outcomes. Capital budgeting aids businesses and organizations in making smart decisions related to large investments by approximating future cash flows, taking into consideration factors such as net present value and internal rate of return. Through this process, companies are better equipped to use their resources judiciously. Time value of money. Have you ever contemplated the idea that money is worth more today than it will be tomorrow? This concept, known as the time value of money, suggests that currency fluctuates in its value depending on changes such as inflation and interest rates. Consequently, your same amount of money may not have the same purchasing power at a different point in time. When managing finances, the value of money over time must be taken into account. As opposed to a dollar earned in the future, today's currency can be invested and grow with interest, making it more valuable right now. It is essential that both timing and amount of cash flow are evaluated when deciding on financial decisions, because their worth lies beyond just the face value. It's essential to understand the time value of money when calculating present and future values. Present value is simply the amount you have today, plus any interest it would accumulate over time. Future value considers what that same sum will be worth in the foreseeable future, based on compound interest earned along its journey. Both calculations are key components in making sound financial decisions today. The time value of money is an indispensable concept in finance and investment, as it equips us with the tools to evaluate the worth of different financial instruments, such as bonds and stocks. In addition, it comes in handy for decisions that involve long-term investments or expenditures. By calculating their present values using this principle, one can decide whether a project will prove profitable or not before committing resources. Ultimately, the concept of the time value of money suggests that currency fluctuates in its worth over a period and will have an altered value due to alterations in inflation, interest rates, and other variables. By understanding the time value of money, investors and decision-makers can make informed financial decisions that consider both present as well as future monetary worth. Risk and return. Risk and return go hand in hand when it comes to financing. Risk is the likelihood of earning back an investment with profits, while return measures the profit or loss generated by an investment. Together, these two ideas form a cornerstone of financial success. Understanding their complex relationship can be key for businesses seeking exceptional returns. It is a generally accepted truth of financial markets that investments characterized by higher degrees of risk offer greater potential rewards, while those with lesser risks provide lower yields. This interplay between the two factors is referred to as the risk-return trade-off phenomenon. To make the best investment decisions, investors must carefully weigh potential risks against the rewards that come with them. For instance, an investor may accept to invest in a risky but high-profit stock if they have long-term investing goals and are willing to withstand short-term losses for greater returns over time. In addition to assessing the level of risk associated with an investment, investors must also consider their risk tolerance, which is the level of risk that an investor is willing to accept. Different investors have different risk tolerance levels, and their investment decisions should reflect their risk tolerance levels. Ultimately, risk and return are two essential concepts in finance that have a strong connection. This relationship is acknowledged as the risk-return trade-off, implying investors must comprehend the level of danger related to an investment and evaluate it against any potential gain. By carefully evaluating their risk tolerance and considering the reward-to-risk ratio, investors can make thoughtful investment moves that fit in with their financial objectives and comfort level. 4. Financial analysis. Ratio analysis. Ratio analysis is a paramount tool used in finance to evaluate the monetary success and stability of an organization. By gauging various financial ratios, this form of assessment provides greater exposure to the company's liquidity, solvency, profitability, and efficiency, as well as the capability to generate cash flow and manage debt. Analyzing ratios can become easier by employing the following categories. Liquidity ratios are designed to evaluate a company's capacity to stick with its immediate financial commitments, like paying out salaries and settling bills. Examples of liquidity ratios include the current ratio and quick ratio. Knowing these measurements is essential for assessing any organization's short-term sustainability. Companies rely on solvency ratios to ascertain their capability to pay back debt and support future operations and other long-term goals. Examples of such analysis measures are the debt-to-equity ratio and times interest earned ratio, both of which provide invaluable insight into a company's financial health. Profitability ratios are the key to determining a company's ability to generate profits and return value on investment. Gross profit margin, net profit margin, and return on assets are all examples of these invaluable measurements. Efficiency ratios measure the ability of an organization to effectively utilize its resources, including both assets and liabilities. Examples of efficiency ratios include the asset turnover ratio and accounts receivable turnover ratio. In other words, these metrics help us determine how quickly a company can transform their investments into income or cash flow. To gain a much more in-depth comprehension of an organization's financial performance, strength, and healthiness, conducting a comprehensive ratio analysis is essential. This involves comparing the ratios to those of its peers, industry averages, as well as its previous results. Doing so gives us invaluable insight into what the company has achieved and which areas it needs to improve upon. Ultimately, ratio analysis is a vital tool for financial decision-makers. By examining the various ratios derived from an organization's financial statements, stakeholders can gain insight into its liquidity, solvency, profitability, and efficiency. As such, it serves as an invaluable resource to guide investors and lenders in their choices, ensuring more prudent fiscal decisions are made. Common-size financial statements. Leveraging the standardized format of common-size financial statements provides an efficient way to compare companies, industries, and different time frames. All financial data is expressed as a percentage of a base amount, making it easier to draw meaningful insights into how each business operates. Common-size financial statements provide an invaluable tool to analyze a company's fiscal situation over time, and also compare the performance of varying businesses in the same industry. On a common-size income statement, for instance, all revenue and expenditure figures are shown as a percentage of total sales. With regards to balance sheets, assets, liabilities plus equity will be portrayed as part of overall assets. By employing this methodical approach, investors can conveniently assess trends across different companies within the sector or identify discrepancies between years. Common-size financial statements are a valuable tool for any analyst, as they provide an efficient way to assess the performance of a company. This approach provides a consistent and standardized format that makes it much simpler to compare data among companies, industries, or periods. With common-size financials at your fingertips, you can quickly get valuable insights into how well, or poorly, different entities are performing financially. It is imperative to remember that common-size financial statements are not a replacement for traditional financial reports, and should be used alongside other analysis techniques to gain an overall comprehension of a company's economic performance and condition. In summary, common-size financial statements are a crucial instrument for evaluating and understanding business performance. By uniformly exhibiting financial data, they make it much simpler to compare companies or years of different sizes. Henceforth, when assessing the vitality and viability of an enterprise's finances, it's appropriate to use common-size financial documents in conjunction with other interpretation tools. Trend analysis. Through trend analysis, financial professionals can review data from multiple periods to uncover patterns that help them assess an organization's finances and forecast potential outcomes. This technique allows for a more comprehensive understanding of the financial atmosphere as it evaluates changes over time, be it years or quarters. By looking at trends in this way, one can develop invaluable insight into how their company has been performing and what they should expect going forward. When it comes to analyzing trends, there are various strategies available, such as by employing revenue trend analysis, businesses can observe modifications in their income over some time to identify any possible sources for diminishing profits and also recognize development opportunities. This kind of evaluation assists companies make well-informed decisions that will enable them to grow both now and in the future. Expense trend analysis can be incredibly useful for organizations that want to control costs. This type of analysis allows companies to gain insight into how expenses have changed over time and identify areas where cost-saving measures are necessary. By utilizing profitability trend analysis, organizations can gain an understanding of their current economic performance and how it changes over time. This process helps to detect significant trends in net income, gross profit, and any other metrics that measure success. With the assistance of this data-driven insight, businesses are empowered with a clearer view of what initiatives will lead them to future prosperity. Analyzing cash flow trends helps to gain insight into how a company's funds are evolving. It offers an understanding of when and where money is being generated or used, allowing for informed decision-making on financial affairs. Analyzing trends can be an invaluable asset to monetary decision-makers, as it provides a clear overview of a company's financial prowess across time. This allows for the easy detection of patterns and movements that may not be visibly obvious in traditional accounts, which leads to better informed economic decisions being made. To sum it up, trend analysis is a tool used in finance to comprehend changes that have taken place in financial data over a set period. This investigation allows us to gain insight into the company's fiscal performance as well as forecast potential outcomes by pinpointing trends and structures within the facts. Trend analysis provides an all-encompassing view of the firm's economic conduct throughout time, making it an invaluable resource for those who make financial decisions. Industry benchmarks. Evaluating a company's financial performance compared to its competitors is an invaluable tool that can be used by industry benchmarks. Not only do these measurements provide the ability to compare your business against those in the same field, but it also gives insight into areas where you may excel or fall short relative to others. Utilizing industry benchmarking can illuminate potential opportunities and risks for businesses on their journey towards growth. Comparing a company's financial numbers to industry benchmarks is an invaluable tool for financial analysts. These benchmarks are established by analyzing data from many businesses in the same sector and may consist of metrics such as revenue growth, profit margins, return on assets, and debt-to-equity ratios. With this priceless comparison comes visibility into areas where a company might be doing better or worse than its competitors, opening up opportunities for improvement or further success. For small and medium-sized enterprises, industry benchmarks can be an invaluable asset in evaluating their financial successes or shortcomings. Without the resources to perform a full analysis of finances, these businesses must contrast their financial data with those of other companies in similar industries. This will provide them insight into how they compare against competitors and allow them to make strategic decisions that enhance fiscal performance. Ultimately, industry benchmarks are quantifiable indicators used to assess a business's financial performance in comparison with its rivals. By evaluating these standards and comparing them to other companies' results, you can gain helpful insights that may indicate if your company is exceeding or lagging behind its competition. Companies of all sizes can benefit from gauging their financial performance against industry benchmarks, but this is especially true for small and medium-sized businesses. By utilizing these standards, they can glean meaningful data that allow them to better understand how they measure up in comparison with competitors. 5. Financial planning and control. Working capital management. To guarantee that your business can handle short-term obligations and maintain regular operations, working capital management is the key. This process involves a strategic approach towards managing the current assets and liabilities of an organization to ensure there is an adequate reserve of cash flow on hand at all times. With effective working capital management, you will have peace of mind, knowing you are well prepared for anything life throws your way. To properly manage working capital, multiple essential elements must be carefully considered, such as accounts receivable management. This is a vital process that requires swift action to ensure customers are paying their bills in an organized and efficient manner, thus significantly reducing the number of overdue payments. Inventory management. Mastering inventory management is key for any successful business. It's all about achieving a balance between keeping enough product in stock to satisfy customer demand, while not having so much that it hampers cash flow and profitability. Accounts payable management. This ensures you can capitalize on early payment discounts and prevent late payment fees with a seamless system for paying suppliers promptly. Cash management. This is key to a business's success. It allows companies to monitor the incoming and outgoing funds, ensuring that they have sufficient liquidity for their present needs. By staying on top of cash management, businesses can maintain financial stability as well as plan for future growth opportunities. To guarantee lasting success, companies need to have effective working capital management. By managing existing assets and liabilities wisely, businesses can amplify their financial performance, reduce risk exposure, as well as make certain that they possess the resources needed to maintain standard procedures. Ultimately, working capital management is a means to achieve the ideal balance of cash and liquid assets for short-term commitments. This process helps companies maintain sufficient liquidity to meet their obligations while continuing regular operations. Working capital management actively works towards ensuring that organizations can remain financially secure in the present moment, as well as into the future. A successful strategy for managing your company's working capital requires several critical elements, including wisely overseeing accounts receivable and inventory, handling accounts payable judiciously, and maintaining a sensible cash flow. Long-term financial planning. Whether you're an individual or a company, long-term financial planning is crucial for ensuring that your resources are allocated and managed efficiently. The process includes creating a detailed plan over multiple years, usually 5 to 10, with the ultimate goal of helping you make informed decisions about your finances to achieve success over many years. Long-term financial planning necessitates several essential components, such as setting financial objectives. This is a vital step for both businesses and individuals, as it involves recognizing the long-term targets that are to be achieved, such as purchasing a house, putting money aside for retirement, or financing tuition costs. Constructing an effective budget. This is essential for long-term stability, as it requires forecasting between income and expenses to identify areas in which resources can be allocated towards investment or savings. Establishing a sound investment portfolio. This is essential for achieving your long-term financial objectives. To do this, you must select the best stocks, bonds, real estate investments, and mutual funds to suit your unique needs. Estate planning. This is the process of making important decisions about what will happen to your assets when you pass away. This includes creating a will, setting up trusts, and selecting a guardian for minor children. Planning can ensure that your wishes are carried out after you're gone. Establishing a retirement plan. This is essential to ensure financial security. This process includes ascertaining the amount of money needed for an individual or couple's later years, and choosing investment mechanisms that can help reach this goal. Creating and consistently assessing a comprehensive financial plan is the key to securing long-term economic stability. Through an ongoing review of resources, allocations, and asset management over time, individuals or companies can make informed decisions that will benefit them for years to come. By dedicating effort towards proactive monetary planning now, you are investing in your future success. All in all, long-term financial planning is the essential key to a successful future. It entails having an effective plan that covers multiple years and allows you or your business to make well-informed decisions regarding how best to use its resources and manage assets accordingly. Long-term financial planning enables you to identify potential opportunities for growth which can be capitalized on, whilst also helping reduce risk by curbing any areas of concern due to lack of foresight. When it comes to long-term financial planning, the fundamentals consist of setting realistic goals, creating a budget plan that works for your lifestyle and income, making wise investments decisions to grow your wealth over time, drafting an estate plan that protects you and your family in case something unexpected happens, as well as retirement planning. Keep in mind that this process is never static or complete. It needs continuous review and adaptation when needed due to changing circumstances. Performance evaluation. Performance evaluation is an effective way to measure and analyze the success of a business or individual's financial strategies. Through this process, key insights are gained on where adjustments can be made to reach objectives more quickly, as well as tracking progress towards goals over time. Evaluating performance can be done in multiple ways, such as financial ratios, to gain insights into a company or individual's financial situation. Analyzing numerous financial ratios is key. These include the debt-to-equity ratio, current ratio, and return on equity, which are used to determine overall fiscal health. Budget analysis. To stay on track to achieve financial goals and objectives, conducting a budget analysis is essential. This process involves evaluating the actual results against what was planned to identify any possible discrepancies. Return on investment, ROI. To determine whether a specific portfolio or investment is providing sufficient returns for the amount of risk taken, this metric evaluates its return rate. Benchmarking. Compare your performance to others in the same field. Benchmarking allows you to measure how well you and your company stack up against industry standards. By taking stock of what's working, where there is room for improvement, and more, it can ensure that every step forward taken will be a successful one. Balanced scorecard. The balanced scorecard is an effective management tool that helps you evaluate performance from a variety of angles, including financial, customer service, internal process development, and learning growth. This innovative system enables companies to gain insight into the efficacy of their operations across several key areas. By conducting regular performance evaluations, companies and individuals can optimize their financial strategies, track progress towards objectives, and make informed decisions. This is an essential part of sound financial management that helps to ensure success by recognizing areas for improvement and identifying opportunities to become more efficient or effective. Performance evaluation will allow any organization or individual to reach its financial aspirations with confidence. In summary, performance evaluation is a critical process to measure the effectiveness and efficiency of financial management strategies. Its main purpose is twofold: 1. Identify areas which can be improved upon, and 2. Track progress towards goals and objectives over time. With comprehensive performance evaluations in place, companies can make sound decisions that will have a positive impact on their operations for years to come. Analyzing performance is an indispensable feature of financial administration, as it assists in uncovering areas requiring improvement and monitoring progress towards monetary objectives. Financial ratios, budget analysis, return on investment, benchmarking, and the balanced scorecard are all beneficial methods for this purpose. 6. Tax planning and compliance. Tax laws and regulations. Tax laws and regulations are intricate systems of guidelines that the government utilizes to collect taxes from citizens. These rules provide a framework for correctly calculating, paying, and reporting all applicable fees, such as federal, state, or local. Depending on your specific jurisdiction, tax law specifications can differ significantly. Tax laws and regulations are of prime importance when it comes to accounting and financial management, as taxes can alter the fiscal health of a company or individual drastically. Therefore, compliance with such tax-related rules is imperative, since flouting them could lead to serious repercussions like penalties, fines, and even criminal charges. The field of accounting and financial management is filled with complex tax laws that involve a range of topics, such as taxable income. Determining taxable income can be a complex task, so it is important to understand exactly what constitutes such and how taxes are calculated on that total. Deductions and credits. Make sure you take full advantage of deductions and credits that can decrease the amount of taxes owed. Knowing what to claim on your tax return is key to maximizing your savings. Tax reporting. Filing taxes can be a complex task, requiring knowledge of the laws and regulations, along with an understanding of which forms and paperwork must accompany each return. By adhering to the required tax reporting requirements, you can ensure that your filings are accurate and timely. Payment of taxes. When it comes to paying taxes, everyone should be aware of the regulations that regulate payment, when they are due, and how they can be processed. Missing a deadline or using an inappropriate method of payment could result in costly penalties. Make sure you stay on top of your tax payments by understanding all applicable rules and guidelines. Ensuring compliance with taxation mandates. The process of audit and enforcement involves carrying out audits to ensure adherence to tax laws. A thorough investigation is conducted as part of this procedure to verify accuracy while also upholding legal standards. Companies and individuals need to be knowledgeable of the tax laws that apply, as well as their influence on financial soundness. In certain scenarios, professional advice from a seasoned accountant might be necessary to guarantee compliance with applicable rules and regulations. Ultimately, the intricate intricacies of tax laws and regulations are a must for properly calculating, paying, and reporting taxes to government authorities. These statutes establish the protocols that all taxpayers, from individuals to corporations, must abide by to fulfill their fiscal responsibilities accurately. Failing to comply with taxation laws and regulations can result in serious repercussions, including fines, legal penalties, and criminal charges. Tax rules traditionally cover a range of topics such as taxable earnings, deductions, and credits afforded to the taxpayer, filing taxes correctly, making timely payments, going through tax audits if necessary, etc. It is therefore essential for both businesses and citizens alike to have an extensive understanding of how these policies impact their financial well-being. Tax planning strategies. By devising prudent tax planning strategies, individuals and businesses can reduce the amount of taxes they owe and increase their post-tax income. Tax planning is an essential element of financial management and accounting, as taxes can significantly influence a business or individual's fiscal health. To minimize tax liabilities, people often look to numerous tax laws, regulations, and provisions. Some of the most common approaches used for this purpose are: tax-efficient investing. Optimize your returns and save money with tax-efficient investing. Make smart investments, such as tax-free bonds or annuities that provide you with great benefits like deferred taxes on profits. Tax loss harvesting. Tax loss harvesting is an excellent way to reduce your tax liability and offset capital gains. It involves selling investments that have decreased in value, allowing you to benefit from the losses without actually having lost any money. Charitable giving. Taking advantage of tax deductions and credits is made easier with charitable giving. Helping those in need while saving money? What a wonderful opportunity to make a difference. Retirement planning. Planning for retirement is made more attainable by using tax-advantaged accounts such as 401k plans and IRAs, which can help to reduce your overall tax liability. Business structure. If you wish to optimize your tax efficiency, selecting the most favorable business structure is key. For instance, consider forming an S corporation or a limited liability company, LLC. Tax-deferred exchanges. Tax-deferred exchanges are a smart way to delay or avoid taxes when selling investments or property. You can quickly and easily preserve your hard-earned profits, while still being able to reinvest them in similar assets. Timing of income and deductions. Optimizing when to report income and deductions can significantly reduce your tax liability. Timing is key. Any tax planning strategies must follow the law, so it's best to consult a qualified professional for guidance. Compliance with all applicable regulations and laws should be a top priority when making decisions about taxes. In the end, tax planning strategies are tactics used to reduce taxes and optimize an individual or business after-tax earnings. Tax planning is a crucial component of financial and accounting management, so adopting tax-efficient strategies such as investing for the future, charitable giving, retirement preparation, restructuring your business entity, or utilizing tax exchange deferments can have a great impact on managing your finances. To ensure compliance with tax regulations and laws, it's recommended to consult an experienced professional in this field. Tax compliance and reporting. Tax compliance and reporting are important measures that people and businesses must take to guarantee they meet their tax obligations, as well as accurately report the taxes due to government bodies. Staying in line with legislation is essential for all taxpayers, making it necessary to understand ways of filing returns correctly. To ensure tax compliance, individuals must adhere to the relevant laws and regulations, accurately compute their taxable income, and submit the payments on schedule. Tax reporting involves preparing and filing all necessary returns, as well as other forms that supply information concerning your taxable earnings or taxes payable to authorities. Tax compliance and reporting involve a few key elements such as record keeping. Ensure you are tracking every financial move made, from payments received to invoices sent. Additionally, to back up your tax return filing process, make sure all relevant documents such as receipts and bills are archived securely. Tax classification. It is essential to correctly designate employees, contractors, and other workers to guarantee that all applicable taxes are withheld and paid. Tax return preparation. To meet all necessary deadlines, I offer professional tax filing services for individuals, corporate entities, and sales payroll taxes. Tax payment. Ensure that taxes are paid on time and precisely, with specific attention to estimated tax payments as well as quarterly obligations for businesses. Tax planning. Strategize how to reduce your taxes and maximize income by evaluating existing tax regulations. Tax dispute resolution. Experienced in navigating complex taxation disputes, our team will help you resolve all types of disagreements with tax authorities, from audits to appeals. Don't let taxation issues keep your business stuck. Get proactive and take charge of the situation by enlisting our dispute resolution services today. To sum up, tax compliance and reporting involve the steps taken to ensure that individuals and corporations abide by their respective countries' taxation laws. Moreover, such procedures also necessitate accurate documentation of taxable income, as well as taxes owed to governmental authorities. Tax compliance necessitates adhering to all relevant tax laws and regulations, computing taxable income precisely, and making any necessary payments promptly. Concerning tax reporting, this involves filing the appropriate forms with accurate information about one's earnings and taxes due to the government. To comply with tax laws, essential steps such as record maintenance, classification of taxes, preparation of documents for filing returns, payment processing, and scheduling payments in advance are pertinent. Moreover, planning to minimize the amount due on taxation and dispute resolution are two important points that should be considered when dealing with taxes. 7. Auditing and assurance. Auditing concepts and standards. Auditing standards are the fundamental principles and regulations that ensure auditors carry out their duties with integrity, impartiality, and objectivity. Such concepts provide a framework to guide them through the entire audit process effectively. To ensure the accuracy of financial records, auditors must be aware of and adhere to various concepts and standards, such as independence. To guarantee that the observations provided by auditors are impartial and unbiased, they need to maintain independence from the entity they are auditing. Professional skepticism. Auditors must approach their work with a critical outlook, striving to acquire sufficient evidence to back up the findings they make. Materiality. Auditors should direct their attention to matters that are of great importance and have a considerable bearing on the financial statements. Evidence. Auditors should acquire adequate and pertinent proof to validate their decisions, involving the review of documents, observation of procedures, as well as conversing with personnel. Professional judgment. Auditors are obliged to apply their professional acumen and make well-informed decisions concerning the audit process, as well as financial statements. Auditing standards. Professional organizations have put forward regulations that detail the exact processes and methods auditors must follow when doing their job. Ultimately, auditing concepts and standards signify the directives that control the audit process, so auditors can maintain their ethical integrity while being impartial and objective in their work. To ensure that auditors offer accurate and trustworthy information to the public, as well as other stakeholders concerning entities' financial position and performance. Key auditing concepts like independence, professional skepticism, materiality evidence, and judgment are essential. In addition to these principles, adhering to reliable audit standards is also necessary for providing meaningful results. Internal controls and risk management. A company's internal controls and risk management are its most important measures to guarantee its operations run smoothly, securely, productively, and with minimal risks. These processes and systems must be implemented correctly for an organization to reach its full potential. Organizations rely on internal controls to protect their assets and achieve their objectives. These procedures, processes, and systems include the authorization of transactions, dividing roles among employees, and confirming that accounts are properly balanced. With strong internal controls in place, organizations can be confident they have taken proactive steps to safeguard against theft or misuse of resources. Risk management is the process of identifying, assessing, and controlling risks that may affect an organization. It includes strategies such as risk identification, assessment, control, and monitoring to effectively manage these risks. By implementing such techniques, organizations can better prepare themselves for any potential pitfalls or issues they might face in the future. Internal controls and risk management go hand in glove. Adequate internal controls can help negate numerous risks connected to a company's operations. Generally, companies will build up an internal control system designed to tackle their risks and tolerance for risk, which is checked regularly, so it stays effective. Ultimately, sound internal controls and risk management are fundamental to successful financial management. These processes ensure that operations are carried out securely and cost-effectively, while mitigating any risks involved in the venture. Auditing procedures and techniques. Auditors rely on various techniques and procedures to acquire evidence, evaluate the accuracy of financial data, and form conclusions about an entity's financial statements. These methods are essential for auditing purposes to guarantee comprehensive evaluations and effective results. Through meticulous procedures and techniques, auditors can acquire the necessary evidence to validate their conclusions. When auditing, some of the most crucial procedures and techniques to consider are: tests of transactions. Auditors thoroughly examine financial transactions to guarantee they have been accurately documented and abide by applicable laws, regulations, and accounting standards. This could involve inspecting supporting documents like invoices or bank statements, as well as conducting substantive analytical procedures. Tests of controls. Auditors administer tests of internal controls to evaluate the efficiency of an entity's control systems. This may include studying records, monitoring processes, or going through walkthroughs. Substantive procedures. Auditors take necessary measures to confirm that account balances and related records are precise, complete, and free of any discrepancies. This involves analyzing numbers or ratios, as well as implementing substantive analytical procedures. Physical inspection. Auditors perform thorough physical inspections to guarantee the existence of assets and inventory. This can involve visiting different locations belonging to the entity, or watching as they physically count their stock. Confirmations. To ensure accuracy, auditors send out confirmations to external entities like suppliers and customers to authenticate the facts provided by the company. Sampling. Auditors employ sampling techniques to select a fraction of transactions, accounts, or data that can be used as an indicator for the whole population. Through testing these items, auditors can conclude the entire sample size. To put it in a nutshell, auditing procedures and techniques are essential for any audit to be successful. They provide the auditor with ample evidence that supports their judgment and decision-making process. Without them, the entire audit would lack the accuracy or completeness of best practices. Auditing procedures and techniques, such as tests of transactions, controls, substantive tasks, physical inspection, confirmations, and sampling, can help auditors to guarantee reliable information is presented with transparency to the public regarding the financial performance and standing of organizations. By using these effective strategies effectively, we can ensure that meaningful data is provided for stakeholders. 8. Special topics. International financial management. International financial management is an essential part of any global business endeavor, involving the strategic procurement and investment of funds, as well as mitigating risks connected with foreign operations. Strategic international financial management is an invaluable tool to maximize the value of any organization and guarantee its long-term success. Through proper usage of their monetary resources, businesses can use this process to gain a competitive edge in the marketplace. Essential areas of international financial management include foreign exchange risk. International financial management involves the delicate dance of managing risk associated with sudden and unpredictable fluctuations in currency exchange rates, a situation that can severely affect an organization's financial health if not managed professionally. Capital budgeting in a global context. When it comes to investing in international markets, there is a need to thoroughly assess risks, returns, and their overall financial effect on the organization. Careful consideration must be taken regarding these decisions for optimal outcomes. International financial markets. Gaining an in-depth comprehension of the workings and structure behind international financial markets, along with learning about the influence of global financial institutions as well as regulatory oversight, is essential. Global capital structure. To ensure a successful international operation, it is essential to understand how best to mix debt and equity financing. This balancing act must take into account such factors as the cost of capital, tax laws, and regulatory requirements. International tax planning. Global taxation is a complex arena that requires knowledge of different countries' laws, regulations, and treaties to effectively manage international taxes. Cross-border financial transactions. Expertly managing global monetary transfers between countries is a complex process that involves understanding currency conversion and foreign exchange rate fluctuations. Hedging strategies. By harnessing the power of currency derivatives and other financial instruments, international financial management can be improved while also reducing foreign exchange risk. Ultimately, international financial management is an integral part of any business that operates on a global scale. It encompasses the successful handling of funds to reach organizational goals while reducing threats. To successfully master this skill set, one must be informed about international financial markets, know how to manage foreign exchange risk, and make prudent decisions involving investment strategies, capital structure, and tax planning. Governmental and nonprofit accounting. Governmental and nonprofit accounting is a specialized field that requires an understanding of the one-of-a-kind financial reporting demands and operating characteristics these entities have. It stands out from commercial business accounting due to its distinct nature, which makes it necessary for professionals to be well-versed in both areas. Key subjects of inquiry within governmental and nonprofit accounting include fund accounting. Government and nonprofit organizations use fund accounting to differentiate financial transactions based on their purpose, including operating funds as well as capital projects funds or grant funds. By employing this type of accounting, it is simpler for entities to track the allocation of resources more accurately. Budgeting and financial planning. Constructing budgets and long-term fiscal plans for government agencies or nonprofit organizations can be daunting due to the intricate resources, multi-year predictions, and compliance regulations that encompass such undertakings. Financial reporting. It specializes in providing financial reports for governmental organizations and nonprofits, such as annual accounts, audited statements of finances, and budget-to-actual calculations. Governmental accounting standards. To ensure adherence to the highest standard of financial stewardship, state and local governments are subject to generally accepted accounting principles, GAAP, as mandated by the Governmental Accounting Standards Board, GASB. Nonprofit accounting standards. Nonprofit organizations that are governed by the Financial Accounting Standards Board, FASB, must adhere to generally accepted accounting principles, GAAP. Tax-exempt status. As a nonprofit organization, it is essential to maintain tax-exempt status to comply with the regulations, governance requirements, and reporting obligations set forth by the government. Grant management. From tracking expenses and ensuring compliance with grantors to providing reporting, the administration and management of grants is a critical responsibilities. It requires attention to detail and precision for successful outcomes. In summary, governmental and nonprofit accounting is a complicated field that necessitates an understanding of distinct financial management and reporting rules. Adopting sound practices in this area of accounting is essential for making sure these organizations remain financially accountable, sustainable, and responsive to the desires of stakeholders. Ethics in accounting and financial management. To ensure that financial decisions adhere to the highest standards of integrity and act in the best interests of those affected, ethical practices must be observed by individuals and organizations working within the realm of accounting and finance. This will not only guarantee credibility for these markets, but also engender trust from stakeholders. Ethics should therefore be a cornerstone when it comes to making sound financial choices. It is essential to familiarize yourself with the key principles of ethical accounting and financial management, which include professional codes of conduct. Professional organizations, such as the Institute of Management Accountants, (IMA), and the American Institute of Certified Public Accountants, AICPA, have established ethical standards and guidelines to uphold. Conflicts of interest. Mastering the art of identifying and appropriately responding to situations where an individual's motivations are contrary to their professional obligations is a critical skill. Integrity and transparency. Honesty, transparency, and responsibility in financial reporting and decision-making are of utmost importance. Fraud detection and prevention. Proactively recognizing and resolving financial fraud is a key responsibility, from embezzlement to inaccurate reports or even altering monetary information. Whistleblowing. Speaking up about unethical or unlawful acts that have been witnessed is not only a courageous act, but a necessary one. Corporate social responsibility. Companies and organizations must take into consideration the social, financial, as well as ecological consequences of their decisions. Moreover, they must strive to prioritize stakeholder interests, from workers and customers to shareholders and local communities alike, in all that they do. Privacy and data protection. It is essential to safeguard sensitive financial information and guarantee that personal data is handled ethically and responsibly for the well-being of our customers. Ultimately, ethics are essential in the world of accounting and financial management. They establish trustworthiness among stakeholders, as well as assure that decisions made within these industries prioritize those it affects. Individuals and organizations must adhere to ethical principles and values. This will result in stronger accountability, transparency, and integrity, three components critical for success. 9. Conclusion. Summary of key concepts covered in the book. The book on accounting and financial management is a comprehensive guide to the core ideas of this field. Here's an overview of what you can expect from reading it. Definition of accounting and financial management. Accounting and financial management are essential elements of any successful business. To understand what these disciplines entail, we have compiled a comprehensive overview detailing their purpose, fundamentals, and importance. The accounting equation. Accounting principles offer insight into the association between assets, liabilities, and equity, a fundamental framework of understanding. Double entry accounting, an efficient technique of documenting financial transactions to ensure the accuracy and dependability of the records. Financial statements. To assess the economic health of an organization, it's essential to scrutinize three financial statements: the income statement, balance sheet, and cash flow statement. A thorough examination of these reports is critical for any business owner or investor who wants to gain insight into a company's current and future performance. Budgeting and forecasting. To effectively plan for and anticipate future financial success, you must use both your company's historical data as well as a variety of forecasting methods. By utilizing these techniques, you can make proactive decisions that will benefit the organization in the long term. Cost-benefit analysis. By measuring the profitability and cost-effectiveness of a specific venture or investment, one can make wise decisions on where to invest their funds. Capital budgeting. Assessing and selecting the right investment opportunities that will provide returns in the long run is an essential part of smart investing. Time value of money. Comprehending the fluctuating value of money over time and how it shapes our financial choices is an invaluable asset. Risk and return. The bedrock of finance is the principle that riskier investments tend to generate higher levels of profit. Ratio analysis. Exploring financial ratios is an excellent way to assess the financial status of any organization. By utilizing this technique, organizations can gain crucial insight into their performance and overall well-being. Common size financial statements, an in-depth financial evaluation that gives you a better understanding of an organization's fiscal performance, allowing for comparisons between the proportions of different components. Trend analysis, examining past financial data to detect patterns and trends, as well as forecast future performance, is the key to successful analysis. Industry benchmarks, evaluating an organization's financial performance in comparison to industry standards is the best way to measure its success and competitive advantage. Working capital management, managing existing assets and debts to guarantee the proper functioning of an organization is essential for success. Long-term financial planning, planning financially requires thoughtful forecasting and strategic decisions in both investment and financing. A comprehensive financial plan looks to the future while also assessing current performance, providing a reliable foundation for achieving long-term goals. Financing decisions, making decisions regarding the allocation of resources, such as debt and equity financing, to ensure financial stability. Performance evaluation. To ensure an organization's financial success, it is essential to measure and evaluate its performance through the use of strategic ratios, trend analysis, and other indicators. With this information in hand, leaders can make more informed decisions that drive their businesses forward. Tax laws and regulations. A thorough understanding of the tax code, regulations, and compliance guidelines are essential for effective tax planning strategies. With an in-depth overview of all applicable laws and regulations, you'll be able to make informed decisions about your taxes. Auditing concepts and standards. Get a comprehensive grasp of auditing principles and practices, such as concepts, standards, and procedures. Internal controls and risk management. Devising and carrying out internal control systems to manage risk and guarantee the correctness and dependability of financial records is a crucial step towards success. International financial management. Effectively managing financial assets across different countries is critical to success, from accounting for currency fluctuations and taxes to reporting requirements. Governmental and nonprofit accounting. Nonprofit and public sector organizations possess unique accounting and financial management methods tailored to suit the need of their field. Ethics in accounting and financial management. An exploration of the ethical considerations and practices that should guide the behavior of individuals and organizations in the financial sector. To sum up, this book offers an extensive examination of concepts in accounting and financial management, laying the groundwork for a clear comprehension of the basic principles and practices associated with these fundamental areas. Future trends in accounting and financial management. In this ever-evolving business environment, staying informed of accounting and financial management's future trends is imperative. To remain on par with the competition, one must familiarize themselves with the following key developments that are likely to shape these areas. Increased automation. The ongoing automation of accounting and financial processes is anticipated to improve drastically, meaning manual efforts to create financial reports will significantly decrease, leaving us with more time for strategic activities. Big data. With the emergence of big data, companies are equipped with an abundance of financial information that can be used to make more informed decisions. By leveraging this powerful tool, organizations will have unprecedented access to a wealth of data, allowing their financial managers to make sound choices and capitalize on opportunities they may not otherwise have noticed before. Cloud computing. In the coming years, cloud computing will become even more prevalent and accessible for businesses. This cutting-edge technology provides an easy way to access financial data remotely and collaborate with others from different areas of the world. Environmental, social, and governance (ESG) reporting. As stakeholders become even more invested in understanding an organization's environmental, social, and governance impacts, the importance of ESG, environmental, social, and governance reporting, is at an all-time high. Artificial intelligence (AI) and machine learning (ML). Artificial intelligence and machine learning are predicted to be increasingly involved in the disciplines of accounting and financial management, serving as a method for recognizing patterns and trends within financial data, streamlining tedious tasks, plus providing perspectives that would otherwise go unnoticed by humans. Accounting and financial management trends will continue to evolve, offering new possibilities as well as difficulties for finance professionals. To stay ahead of their competition and guarantee financial success in the years to come, businesses must keep up with these advancements. Resources for further study. If you're looking for ways to boost your knowledge on financial management and accounting, there are many resources available at your disposal. Here's a look at some of the top options. Books. If you're searching for a comprehensive resource on accounting and financial management, there are plenty of options out there. Financial Management, Principles and Applications by Sheridan Titman, John D. Martin, and Arthur J. Keown, or the classic Intermediate Accounting by Donald E. Kiso, Jerry J. Wagant, and Terry D. Warfield are both great picks, offering an array of topics from fundamental concepts to more advanced techniques. Online courses. Learning about accounting and financial management is now more accessible than ever before, thanks to the plethora of online courses available at your fingertips. Whether you're a beginner or an expert in this field, platforms such as Coursera, Udemy, and edX offer convenient and flexible options to acquire knowledge with their wide selection of courses. Professional organizations. Becoming a member of respected organizations like the American Institute of Certified Public Accountants, AICPA, and the Institute of Management Accountants, IMA, offers access to advantageous resources as well as profitable connection chances. Conferences and seminars. Staying abreast of the most recent developments in accounting and financial management has never been simpler than attending conferences and seminars. Professional organizations typically hold yearly events to provide attendees with an opportunity to learn from leading experts, as well as connect with fellow professionals in their field. Internships and apprenticeships. Completing an internship or apprenticeship is essential for gaining valuable experience in the accounting and financial management industry. Not only will these opportunities provide you with hands-on knowledge, but they also give you a chance to apply what has been taught in class in a real-world setting. Taking advantage of these resources will allow individuals to continually develop their understanding and abilities in the areas of accounting and financial management, thus aiding them in accomplishing success within their professions.